Okay, good morning. Thanks a lot for coming today. It's a pleasure to be here. It's the fourth Value Day, Swiss Value Day, and it's always good to be here presenting our thoughts and sharing our experiences. So in April, I was thinking what to touch today in terms of sharing ideas with you. And then in April, if you remember, we had Trump, we had Liberation Day, and then the markets quickly corrected, and then some of the brokers and the participants said that the recession probability was 60, 70, 80%. So I said, okay, let's touch how to survive, how a value manager survives a recession. So you see here that, most value managers, we don't think that macro is the main driver of investing. We invest in stocks that we select for the long term at a good price. But there is an obvious correlation between recessions and market corrections. So in this past century, you can more or less highlight 12 recessions, and you can see that the indexes, most of them are down between 20 and 50%. So I'm in the market since 1992, more or less 30 years, and I've lived half of them. And it's really amazing, this correlation. So now Trump gets there, Liberation Day, and even now, yesterday Israel has attacked Iran, so there are chances of recession. So what should we do? Is going to be a recession? Nobody knows. Nobody knows, and we cannot really know. So this is psychology. There is an economic downturn, there is fear of recession. Even if there's no recession, then the market collapses. There is massive negativity and panic. So, as a portfolio manager, what you get is amazingly negativity. You have friends, family, very scared, media completely negative, focusing on the negative news that sell more, brokers, experts, momentum, because people are looking at the next 6 months, not over the long term. Mr. Market enters in panic, and the day-to-day is really awful. I can tell you, you have NAV going down every day 3%, investors calling, redemptions every day, profit warnings from the portfolio. It's really a nightmare for a portfolio manager. You need to really be very strong and very experienced in order to pass this. And then the business model doesn't help. This is a model that I built very, very simplified from a kind of medium-sized asset manager, 1 billion asset, which is not bad. Then you get fees after cost of 7.5 million using 0.075. Cost of a team, $5 million with some analysts, with some portfolio managers. Pre-tax profit, 2.5. And what happens is that in 3 months, you get a 35% correction of the market and then a 10% redemptions, and your assets go from 1 billion to half of that. The costs stay, which means that the pressure is not only the market, it's also the companies, it's also the entourage and the company. So it's a big nightmare. If I would assign a risk category to this business, it would be a 4, so high risk, and also high return, because initially boutiques are more efficient. They should make more returns than the large institutional investors. And you see that in the portfolio managers, how many old portfolio managers are there. There's not too many, because if they do well, they retire, because they don't want to cope with this crisis. If they do bad, you can imagine what happens. And Buffett, he showed the way out with Berkshire, so how to take an asset manager out of the noise. And this is a friend. This is an electrocardiogram taken in the COVID in 2020. So you see the anomaly there. It's, physical reaction. Even if you are really understand where you're invested, you normally fight against everybody, against your investment committee, against your family, against everybody. And you need to really be very strong. And this is the price we pay. And we pay this price also for our investors, because we need to be prepared for that. So what should we do in case of a recession or a crisis? Think long term, think like a businessman. I mean, nobody sets up a company in order to make money in 6 months and then sell. If you set a company, you want to be there, compounding cash flow for many, many years. Obviously, you need to review all the investment cases, because recession has an impact, and you need to go through all the companies and see what is the impact, and we did that in the several crises, and it takes a long time. Cross-check. So personally, what I have is a group of friends, very experienced, that I, lean on when there is bad moments, and do nothing, because in a crisis, in a recession, you need to be ready before. If you get to the crisis, to the recession, the portfolio is not well structured, it's too late. If you change the portfolio in the middle of the recession, you can make a big mistake. Will it happen again? You know the response. So the economy is cyclical, you may have a war, fear is basic, psychology, and then most of the market participants really do not know well the stocks, and even worse with social media. Social media is just putting a lot of news out there that do not make any sense. And even modern finance, there's too much momentum. So in the end, it's pro-cyclical. When the cycle goes down, well, everything is bad, everybody follows this momentum. So this is the negative. Let's go to the positives and the real world. It's a fantastic opportunity. If the market corrects 20, 25, 30% is a great opportunity. And let's go to the basics, is what Warren says: be fearful when others are greedy, and be greedy when others are fearful. And most people get it backwards, which is an interesting part of the quote. So 2 comments here, very important to understand difference between price and value. Price is what you pay, value is what you get. Second is the margin of safety. Margin of safety is not only that you are protected in a downturn. All of us buy cheap because we are value guys, but it's also you enhance the returns. If you buy the same company with a 30% discount, your return will be bigger or higher. I chose that to give you an example on that, to tell that the companies can be valued, that you can calculate an intrinsic value for a company, you can calculate an expected return for every company, and I chose the housing because it's easy to understand. To value a house is relatively easy. The intrinsic value of a house would be, you can see 3 ways: replacement value, so land, construction cost, other costs, or the NPV of rentals, or transactions in the area, right? Trying not to measure that in a bubble or in a depression phase. So if you do this calculation and your house is $500,000 value, would you buy another one when the market says it's 1 million worth? Would you sell it at 100,000? Doesn't make any sense. So I wanted to use this because it's more visible than doing a valuation of a company, but it's the same mechanism. And then you can say, well, Marcos, you're too simple. We know all that. All this is so easy, it's basic. Well, this is Magellan. This is one of the best funds until 2000. The compound rate was 22%, Peter Lynch. And so the red line, you see the performance, 20% plus, amazing per year. So this means double your money every 3 to 4 years. The blue line is the assets. So if you realize that half of the assets, so the fund went from 40 billion to 120 billion assets in 5 years. So half of the fund bought at very expensive prices. So what happened then is normal. Basically, you see that the fund starts to underperform a little bit and the assets go down, which means that if you calculate performance of the Magellan fund weighted by assets, it's single digit. Why? Because people buy here and sell here. So now the contrary, what we were commenting on the housing. So it looks easy, looks basic, but nobody does it. This is what we try to do at SIA. You know very well that we calculate intrinsic values and IRRs per stock, so we have the average for the fund for many, many years. So Alex did this chart where you see the IRR is quite stable of the classic. It's a global value fund. And you see that in COVID 2020, and I highlight this because in another slide I will comment that, in COVID, stock market and the fund fell 35% and the IRR went up to more than 20%. And then you see what is the normal pattern. So basically our IRR is trading on normal markets at 14% IRR. When it is cheap, it goes to 16, gets expensive, it goes to 12. So this is an anchor for us. Forget recession, forget momentum. You buy cheap, you sell expensive, you rotate things, and then in the limits, in the high, when there is a big crisis, then you need to really double down and triple down. And I will comment on that. But the question mark is, what do you do when the IRR is 20% in the middle of the COVID? Is you buy. And that's it. Conclusion, buying cheap sorry, but it's as basic as this. Companies can be valued. There's a lot of portfolio managers that I hear out there, they don't have really intrinsic values, IRRs, and then I think, well, it's easy. Who has an IRR on Tesla? It's really meaningless. So also you need to be in your circle of competence and value what you can value, right? Portfolio has to be pre-prepared, and this is Warren Buffett. He says you need to be ready, and portfolio needs to be built in order to cross cycles. And then money follows momentum. It's pretty basic, but it doesn't work. People will buy here because everybody is very positive and sell here. We do the contrary. And a comment from Warren, he says, Charlie and I rarely get the same IV. So there is an art in the calculation of IVs and IRRs. So how we evolve within SIA? So basically, very easy, we did three things. We focus on quality, so we used to be more deep value, now we are more quality value or strategic value. We buy at a discount what only good businesses. We used to buy very normal businesses at a deep discount, we don't do that. Now we want businesses that generate value across cycles, and then we have a kind of unique or different portfolio construction, which I will comment quickly. And again, predicting rain doesn't count, building arcs does, and this is what we try to do. So very fast quality. We do strategic analysis of the sector. We do strategic analysis of the company. This is Porter. And we choose the multi-businesses. So entry barriers, to put it simple. And we say the 4 Gs in order to be easy to remember. Good business, good balance sheet, good management, and good price. We are cheap. This is the PE of our fund, 13 times 2025, 11.6 times 2026, price to book 1.7, MSCI 3. So we are cheap, we buy at a discount, even with quality, and this is, by the way, the classic return on equity average is above 15%. Third one, concentration and diversification. You can see one slide, half of the classic book. So you can very easily understand where we are invested. Plasma proteins, cleaning, OTC and consumer products, food and meat vouchers. Medtronic is MedTech. Leroy is Salmon Farm. ASML, semiconductors. You see here that in 10 names, where there's half of the book, there's not really a single driver that can kill me. Nothing, no China, no sector. It's very well diversified, and it is very well concentrated. And this is also something we do differently in order to take advantage of the market recessions. When the market gets expensive, we buy more quality, 1 and 2s. Now we have 2/3 of the book in quality names. When the market crashes, high beta, 3s and 4 that are more cyclicals, they fall more, and we change the portfolio, we buy what is down a lot. And this we really tested just one time, big time in the COVID, because you don't have many recessions, and I will tell you what happened. This is the COVID test. You remember the IRR when in the old slide was 20%. This was COVID. 5 years later, the IRR of the classic, 22%. It is working. If you do one DCF, maybe the model is not very sound. If you do 35, you have assumptions per company, too many assumptions, too many margins, too many. So it's really a robust model, and it's worked. And we are very happy that, reversing the portfolio when there is a crisis, you take the opportunity to invest very cheap, even in quality, in high beta stocks. So what are we doing now? Basically, we entered in 25 very high in 1 and 2, so kind of quality defensive, entre guillemets. We had 8 or 9% cash. I had that for 2 years, too conservative. Probably I lost some performance with that, but I was kind of fearing a recession. And then we got a bid on one of our names, Catalana Occidente, an insurance company, so the cash went to 12% just before the Liberation Day. And we have reinvested that, 50%. 50% of this has been reinvested at the lows. And we were saying, okay, if the market falls another 15%, then we will reinvest another 15%. So the thing is, when you see that clearly, the IRR is very high, but you don't invest everything in the first moment. Just wait, and more or less our time horizon to reinvesting would be, I don't know, 3 or 4 months. Now the IRR of the fund is 16.5, so there's still a lot of value. This is pre-fees. And you know, think long term. This is the classic since 2012. It's been 14 years. So I'm managing the fund with Carlos until 2019, alone since 2019. Then we have the investment committee, obviously. It's 10%. So forget the recessions. 10% is doubling your money every 7 years. And the portfolio is quality and the portfolio is diversified. So I don't think why we should just change it. But the thing is, you know, these recessions, the big one, the white is COVID, and the red one is the Liberation Day. We use them to enhance the returns. Yeah, then finally, a couple of minutes from me. What do we have? This is the same message. It's a little bit less technique. Basically, I try to identify growth cycles and value cycles, and you see that in the last red line, you see that the last growth cycle where value has underperformed has taken 15 years, basically since I don't know, 2010, more or less. So 3 value cycles and 3 growth cycles. We think that we are entering, I agree with Alex, and we are not coordinated, so Alex is free and George is free, and everybody more or less comes with the same conclusion. We think there is a new value cycle starting. Why? Valuation. Growth stocks are on average 26 times earnings. Values are 14 times below historical, so there's a big gap in valuation. We see the Magnificent Seven and the US big stocks maturing, so they are heavyweights in all indices, so they should have an impact. And then the economy, as we were discussing here, we move into a more inflation area. High inflation correlates with value, correlates with commodities, correlates with capex. So we think that we're going to see, I don't know, I hope 10 or 15 years of value outperforming. And this is the same message, you know, value has lost market share in a big time. So this is the global value funds as percentage of large caps. This is a light blue line. Market share was 30% in 2006, and now we are moving 5 to 10%. So really value is almost out of business. And the same with the weighting. So, you know, America, the weighting on the MSCI is 70% plus, and the weighting in GDP is 25. We are not saying that this will correct tomorrow, but we say that, you know, the index is heavy weighted in the US is heavy weighted to the Magnificent Seven, and the Magnificent Seven are quite expensive, and they are so huge that growth cannot be double digit anymore long term. Conclusion, we think there's a new value cycle. It should be long. It takes 10, 15 years normally. We think active management should regain some share, and our fund gives 15% return net of fees now. Our numbers indicate 15%. You can make mistakes, you can make successes, should be more or less feasible as we show with the COVID. And this compares with what Alex was saying. The MSCI, according to Goldman, is expected to do 3. So, you know, I think we can get some conclusions here. Value should be there for the next 10 years, hopefully beating the index. And then passive cannot work if the index does not do 10%. Passive has been easy, ETF has been easy, index has been easy because the market has been doing 12, 13, 14% for 10 years. We think that this is over, and slowly we will go to a mean reversion. And I think, yeah, 1 second of advertising. This is our proposal, quality value. We are small, non-institutional, a lot of experience. We are obsessed by risk. Track record, 10, 11% for 15 years. Long term, long term, long term, and very transparent. So we are here to, you know, talk to you after in the cocktail. Thank you very much.